Hello Sector Watchers, welcome to the show. This is the 161st episode of Sector Spotlight for Tuesday the 31st of January, and I'm recording it on Monday the 30th. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. In this episode I will address the current state of rotations for asset classes and then dive into sector rotation while dividing the universe into three groups: offensive, defensive and sensitive, and see if we can find any interesting alignments or developments that may contain a message from the market. Spoiler alert, yes we will. And that is also the reason why I have shifted the segment on seasonality, which I usually do on the last Tuesday of the month, forward to next week. Ladies and gentlemen, this is Sector Spotlight. The asset class rotation, as shown on the RRGs, especially on the weekly basis, is showing strength for fixed income related asset classes. So we have corporate bonds here in the green moving into that leading quadrant. We've got government bonds improving, already entered the improving quadrant, and we've got high yield. It's a little bit hard to see, but it has turned back up towards the leading quadrant. And we have SPY, the asset class stocks, moving towards the lagging quadrant. So the immediate takeaway from this RRG is that we have currently a rotation going on out of stocks into more fixed income related asset classes. If you look at the other ones here on the chart, that's GSG and DJP, those represent commodities. And we've got the dollar index, which is basically cash US dollars, and they are deep inside the lagging quadrant with a little hiccup for GSG, but nothing material or significant yet. If we bring that to the daily RRG, then we can see slightly different. We see the strength of stocks, as we saw it last week, represented in that improvement for SPY. It still is inside the leading quadrant. And the fixed income related stuff, LQD, HYG and GOVD, are moving through lagging. With the longer term tails moving as they are, I'm currently looking for these daily tails to start picking up again. And when you see GOVD, HYG and LQD picking up relative momentum and starting to move back up again, provided that these longer term, these weekly tails remain in their positive heading, that would be a confirmation or underscoring the strength for fixed income over stocks at the moment. Almost similar, but then on the other side is the strength for DJP and GSG in the commodity section, which went through a pretty good week last week, but as you can see, the longer term tails are deep inside lagging. So when we see DJP and GSG already started to roll over, when we see that rotation continuing on the daily, then I think it's going to reinforce the weakness for commodities on that weekly RRG. The dollar index finally is inside the lagging quadrant on both RRGs, both the daily and the weekly. We see a little hiccup, a little improvement on the daily, but with that weakness in the weekly, and especially the distance from the 100 level on the RS ratio scale, it's going to be very hard for the US dollar to actually start outperforming VBINX, because that's what we're comparing it to in the near term. We'll have a look at the US dollar chart in a minute. Let's look at some of the individual charts and compare them to what we see on the RRGs. And we're going to stick with the weeklies because that's kind of the time frame that we're dealing with here in Sector Spotlight. So if we start with the US dollar, then we can see that we have this massive decline from 114 all the way down to 101. And this is an important level, but we already broke 104, which is the level that we started watching before. On the longer term charts, and I'll show you that monthly in a minute, we are in a very important range for, in this case, euro dollar. And the question is whether the dollar will turn around here, and for the dollar index that would mean putting in a low and starting to rise again, and basically we have to see this as the first corrective move after this immense rally from 90 to 140 from early 21 and then all through 2022 and out of first correction, and then maybe we can go up further. That's the big question, but this is sort of the point of the last resort. We really need to hold here to keep that scenario as an option. If we look at the euro dollar chart, and this is the weekly chart, you can see the improvements. Obviously, this is the reverse, the dollar index, so the euro dollar is the inverse of that dollar index. The dollar index is comparing a basket of currencies against the US dollar, and here we've got the outright comparison of the euro against the US dollar. Here we see that we're taking out these overhead resistance levels that we've been watching so closely for the last months, maybe even a year already. So first it was 107, then it was 108, and we're already above it. We peaked at 109, we're coming off that a little bit. And if we look at this is the chart that puzzles me most. This is the really long-term chart of euro dollar on a monthly scale. And this was that 104, 103, 104, and you could even argue 106 here, and we're pushing above that, and we can stretch that a little bit if we bring it right here, and you can see that we still have some touch point right here and right here. But again, we're stretching it. We're trying to look for reasons for this to peak and start moving down again, and that's a dangerous situation. So I'm going to try to keep an open mind. It looks as if we're gonna need some sort of a correction anytime soon, because this has been quite a rally. But if we get a higher low in place, then I think that euro dollar is in for a further rise, and we could go back to, you know, this was the massive head and shoulders that we had around 117. Look at 115. There's overhead resistance there. So plenty of upside if this. And it looks as if we have started a new series of higher highs and higher lows. It's kind of hard to read because we're in such an important resistance area when you look at the monthly. So that's why I'm kind of careful with calling a new uptrend for euro dollar, because I really do want to see if we can actually stay above that old resistance level that we seem to be breaking right now. So this was that monthly. So here, if we move on to the fixed income stuff, here is government bonds. We saw that break. It's pushing against overhead resistance and seems to be failing for the last 3-4 weeks. And that makes that relative strength against VBINX kind of sideways. And that's what we also see here in IEF. We're pushing against that old support level, now acting as resistance. We peaked slightly higher than the previous one, but look at the relative strength here. It's kind of moving sideways without a very clear direction. All in all, when we look at SPY, and obviously that's the chart everybody's looking at, and including me, wrote an article this weekend with the title, Is This the Break? And the break that a lot of people have been watching is the break of that falling trend line that's coming over that major highs since the start of 2021. That is definitely broken. We have a short-term uptrend series of higher highs and higher lows, but I do think that the proof is in the pudding, and obviously, as always, horizontal resistance levels, horizontal lines, horizontal levels are much more important than angled trend lines, because they're very debatable in much cases, very subjective. A lot of people draw trend lines in different ways, and so I prefer to pay attention to the horizontal levels. Obviously, the break of that falling resistance was a good sign, was a first sign, but it's not really something that I would bet the farm on. But look at that 4.0, just below 410. We've got 1, 2, 3, and now 4 touch levels there. That's important. And if you go back a little bit further in history, it becomes a little bit more blurry. These are very nice, accurate touch points. Go back in history, it becomes a little bit blurry. Here and here. Here something happened. Here market sort of moved around that level. So it is an area of interest. And especially if you look at the daily chart, the weekly chart, it becomes super interesting because what you can see here, that previous peak was 40861. And last week we peaked at 40816. You can't make that up. That is a real resistance level, especially if you compare it to the high here, which was 40817. Look at that, that's 1 bip off that high here. So that's a resistance level. If we take that out, and that's a big if, and we close above 408 something, 408.5, depending on how aggressive you want to be, I think that opens up the way for a rise to at least 428, because that is the next important horizontal resistance level. And if we can hold, if we break out and we can hold above that 408 level, that old resistance will then become support. We got a lot more constructive situation in the S&P 500 to actually push higher. We're not there yet, but please keep an eye on it, because that 408 area, 408, 410, that area, I think is going to be very important and crucial for the future developments in the S&P 500. If we compare stocks to bonds, it's obviously always a very interesting asset allocation bet, if you want. And it sort of represents what's happening on the RRG. You can see those rotations, they remain very close to the benchmark, which means that there is not a lot of clear direction. If you look at the RRG right now, you can see, as we said, improvement for fixed income stuff, government bonds, high yield, and less so for SPY. And if you look at the comparison SPY IEF, SPY Gov, IEF will be somewhere here. As a matter of fact, we can stick that in. That's a nice show for you. So if we stick in IEF here, we got that same graph. I need to take off Bitcoin. And you can see, so here is SPY IEF. That's the comparison that we have right here. I think there's two ways you can read this chart. So the first one is we're still in a trading range between roughly 3.7 and 4.2. You could argue that there is a triangle being formed. So the triangle then would connect 1, 2, and on here a whole range of highs over the last couple of weeks. And then last week it touched it again. And here we have, if you call this 1, 2, 3 touch points. So it would be like a very good symmetrical triangle situation. The only thing that might hold me back is that we are kind of at the extreme of a breakout level, because you know that for a reliable breakout, the triangle should be broken somewhere around 2/3 of the base of the graph, and that would be here until the apex of the triangle here. So we're kind of in that range. If we're going to call it a triangle, we need to break out pretty much any week now. Nevertheless, we seem to be touching the upper boundary, and as of today we started moving lower again, which is in line with what we see on the RRG, where SPY is moving towards lagging and IEF is moving towards leading. So in the near term it looks as if we're going to have a slight, and the key word here is slight, preference for bonds over stocks, but it isn't going to be much. So for the time being, I mean, maybe just a balanced portfolio as it is in VBINX, with a slight overweight for bonds and a slight underweight for stocks is the ideal situation. Remain close to home, no big bets, because there is not a real clear trend in either of those asset classes. The one that I ticked off here was Bitcoin, because that is the one that is moving this year, this month, start of January. You can see a lot of strength for Bitcoin, and if you have read the news, then you probably have seen all the articles on the recent strength of Bitcoin and cryptocurrencies in general. And that is reflected by that strong tail on the RRG. And if we bring that to a price chart, then you have the weekly chart of Bitcoin right here, and you can see that after that break came back above 18, and we're now on our way to the 25K on the larger scale. 25,000 is the most important resistance level, I think. If you look at the daily, there is a little bit of weakness happening, and I think there is a very nice negative divergence holding up. So the question is whether we will see a further rise and we reach 25, or, and that's I think more likely because of this divergence and the rally that we had, a correction, and that could go back to, it could be either 22.5, which is the area right here, 22.8, and I would say 22.5 here. If we take that out, it could be 21.5. That's the breakout level that we saw here. That's much more important. So if you're interested in trading Bitcoin, then I think that the ideal situation would be a pullback based on that divergence towards between 21.5 and 22,000 US dollars. A new low in place here would be an ideal situation to pick it up for a new rally towards 25K. And after that, we'll have to see what happens. For this week's overview of sectors and sector rotation, I want to go back and grab to that separation in three groups. So the offensive, defensive, and sensitive groups of sectors, and see if we can find a message when we divide the universe in those three groups. We start with the group of offensive sectors. That's on the screen here. Oh, by the way, I'm going to stick with the weekly RRGs and the weekly charts and not look at the dailies because I'll probably be spending too much time talking about stuff that is too short and going to be old by the time you watch this. So we're looking at the weekly RRGs with the weekly charts and see if we can find some form of alignment and maybe a message that the market is sending us. Again, we have the offensive, the cyclical sectors here on the RRG, and we can see materials and financials on the right hand side, but rolling over. That means that they're still in a relative uptrend versus the S&P 500, but they're going through a period of loss of momentum, relative weakness. On the other hand, we have consumer discretionary, which is still inside the lagging quadrant, but recently started to pick up a lot of relative strength, a lot of relative momentum. And the last 2 weeks also a little bit of relative strength, but it's still the furthest to the left on the RS ratio scale. Real estate has been doing really well. It's inside the improving quadrant, but it's now starting to level off. Still at a very decent RS momentum level and moving to the right, so that is the good news. If we look at those individual charts, you can see why materials is rolling over. That price has touched resistance and has not been able to push higher in the last 4 weeks, and that is causing relative strength versus the S&P 500 to peak, to roll over, and you can see that it happened exactly at the previous peaks that were formed in May 2022, and this one here is of May 2021. And that's causing those RRG lines to roll over, and obviously that translates into that tail that's rolling over there. If we go to financials, you can see kind of a similar pattern. You can see that the financial sector has been trying to push higher, hasn't worked as of yet. 2 times we peaked above that resistance level. If we break that, obviously it's looked very good, but right now in the near term it's having trouble in that area, and so does the relative strength, and that's why the RRG lines are rolling over, causing that tail to roll over. If we go to real estate, that is probably out of this group the strongest sector. You can see that we're breaking above the previous highs, which is a good thing. On relative strength terms, it needs a little bit of work. That's why that RS ratio is still way below 100. But the first signs of improvement are there. And especially when we can confirm that breakout here and move higher, then there is quite a bit of upside in terms of price. And there's no doubt that that will improve the relative strength conditions as well. If we then go to consumer discretionary, most important sector here in the offensive, very heavyweight in the S&P 500, you can see that we've broken that falling trend line. That's the good news. And as I said in my analysis of the S&P 500, the proof is in the pudding and the horizontal levels are way more important. It's the same here for consumer discretionary. I think we need to look here between 148 and 150. That's the overhead resistance level that needs to be taken out. Right now we're cooling off a little bit, we're coming back, so this could be the first higher low in the making. If we go lower here and we put in a new higher low, that will be a very good sign for the consumer discretionary sector going forward. But for the time being, that's all looking into the future and we don't know what's going to happen there. For the time being, this is touching resistance and it's going to be difficult to overtake that. If it happens, if we can put in a higher low, if we can take out that resistance, then obviously relative strength will also improve. So for the group as a whole, for these offensive sectors, it's still a little bit of a mixed bag. There's definitely improvement visible, but it's not really confirmed yet. If we go to the group of sensitive sectors, and you can see that communication services is doing really, really well. Technology is picking up. It remains on the left-hand side, and you can see how close all these observations are together. That's relatively short tail when you compare it to the other sectors here. Industrials and energy are on the right-hand side, but they're rapidly losing relative momentum. Look at the length of that XLE tail here. If we bring that to the individual charts, then we find communication services probably the strongest in this group. We already broke that falling trend line a couple of weeks ago. We saw that. We touched that resistance level. We put in that first higher low. Remember what we just said about the discretionary sector? If that can happen in discretionary, then we're in good shape. XLC is ahead of that game. We're already above that 51, 52 resistance area. We're now touching the next one. That series of higher highs and higher lows is in place. And that goes also for the relative strength line, which is pushing those RRG lines higher. Near term, we can have some form of a correction because, again, XLC is running into resistance here, but the underlying trend is positive and it looks good, and that could definitely push XLC further into the leading quadrant. We go to technology, then the improvement is also visible, not as strongly as for XLC, but it's definitely there. Looks very much like the S&P 500, overhead resistance, falling resistance already broken. We do need a confirmation, and the confirmation will be a break above 139, 140, and that would free up the way for XLK to push to 150, 152. And that will also bring relative strength back above its former support, now resistance, which will help that tail improve further into that leading quadrant. Industrials, similar like materials, similar like a lot of these other sectors, rallied, broke out, and now we're in sort of a sideways consolidation type pattern. Relative strength, still pretty good, but short-term losing momentum, and that's why that tail is rolling over here. If you go to energy, similar, pushing to overhead resistance, goes as well for relative strength, and that's why those RRG lines are rolling over here, putting XLE still in a relative uptrend, but losing relative momentum. Now the most important, and that's why I saved it for the last, because I think here in this group we will find a message from the market, and that's the group of defensives. Remember at the end of 2021 when I was looking at those charts, especially in these groups, and I said, hey, that's weird. You can see all those defensive sectors starting to improve while the market is going higher. Right now, it looks as if the opposite is happening. Look at that RRG. Look at those three defensive sectors. It's utilities, staples, and healthcare. Especially staples and healthcare rolled over, moving in a negative RRG heading. Utilities didn't make it into the leading quadrant, already rolling over. I mean, of course, these are still relative uptrends, but I find it fascinating to see how all these tails are moving in a negative RRG heading, while the others here are kind of mixed. This defensive group is the only one where all tails are moving in the same direction to the southwest, the negative direction, towards that lagging quadrant. And if you look at the individual charts, then you will see why. Here you see utilities. Remember all these other charts that broke out to the upside and they're moving in those little trading ranges? Look here, utilities. Been playing around with that old support, now resistance area. And now it looks as if we're breaking. Is it a double top? I don't know, maybe, but it got all the signs of it. And it looks as if we're breaking lower. Look at consumer staples. That is definitely, I could call that a double top. We tested it and we're now breaking below this low. That is not a good sign. And look at healthcare. We tested resistance, couldn't break it, and we're now breaking below this former resistance area, which should act as support, but it's not doing it. It's now breaking lower. And all these relative strength lines are rolling over and breaking previous lows, previous support levels. So my main message at this point in time is that, again, the group of defensive sectors is sending a signal. And the question is it as early as it was in 2021? It's definitely something that I think we should take a look at. Stocks and bonds are still very close together, but the fact that these defensive sectors are now starting to show signs of weakness, while the market is still in a downtrend, probably not anymore, but turning around, I think that is an important message that we should take very, very seriously. And that wraps up the show for this week. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. And of course, you can also catch the replays on YouTube or any of the on-demand channels. A thumbs up is always appreciated, and if you have any comments or questions, put them in the comment section and I will respond there. Looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.